Hello and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Ahmie Baum. He's the CEO of Interchange Capital Partners. Welcome, Ahmie.
Hey, thanks for having me. Nice to be here, Ron.
That's cool. So I always like to get into kind of how you started, the origin story. I joke around a lot. It's kind of probably getting old for people listening to every show. Is like you were born and then you ended up on a show about mergers and acquisition. Can you fill out the gap in between somehow?
Sure. About 40. I came from a family where my father, his number one comment to me is, "What do you think? Money grows on trees?" So that was the starting point. And yet when I look around, because we lived in a middle-class neighborhood, even though we weren't really middle class, I don't know how he pulled it off, but there seemed to be lots of money trees around. And so that was the starting point for me at a very early age to recognize, how do you build a money tree? And the family had a family business. There were three brothers, my father and two brothers, and they went bankrupt, and they all went in three different directions. My father went into education, became a PhD, doctorate in education, did a bunch of things, but there was never. It was always the problem about money, and I didn't really recognize it all. It didn't all come together until I had gotten into college, and I came home and I was excited because I was just an okay student, frankly. I didn't really apply myself. I turned to my dad and I said, "Hey, I got into college." He said, "That's great. How are you going to pay for it?" I said, "What?" Okay, what do you mean? And that was the beginning of me understanding that a lot of the issues that were my mother and father would fight about, or the challenges and the tension, had to do with the fact that there really was no money around. There was no safety net. My father was living on a tightrope, and I made a commitment to myself at that time that I was going to create a safety net. I didn't know exactly how I was going to do it. I picked up a book, which is the classic book, Think and Grow Rich. And that sort of got me thinking. And the one thing I recognized from that, the number one takeaway was, if you can help enough other people get what they want, you'll get everything that you want. And that sort of was the beginning of my pathway. And then through college, I had to put myself to work, and I met a friend of mine, and we ran a restaurant together, and his father was a stockbroker for E.F. Hutton, and I didn't know anything about stockbrokering. I didn't know anything about E.F. Hutton, and he said, "I got you a job." "Well, what do you do?" And I went in, I did the interview, I was able to get through the interview. I turned the question. There's a classic question at that time is, "Well, what's your weakness?" And I said, "Candidly, I don't know anything about your industry, but I can learn. And if you've got a good training program, I can be successful at this." And he liked that response, and he subsequently hired me. And I started the journey as a stockbroker and became familiar with financial services. I didn't really like stockbrokering. I felt it worked for me because I smiled and I did the hard work that was necessary, but it didn't seem to work for the client. And then I moved into, at that time, into two areas. One was financial planning, I became a certified financial planner. So I began to understand holistic. And then I also learned about the consulting services division of E.F. Hutton, which really was about how very wealthy people and pensions and profit sharing plans, people who had to run money for others, how they did it. And I began to pioneer at a very early stage in the early 80s fee-based money management, which is what is now the standard. So as I kept working through that, I began to recognize that the the biggest sum of money that people get was either from working real hard at a corporation or their own business. That's where it all was. And when they had to unlock that lifetime of work is when they really needed things. And so we started focusing on what we call succession transition planning, unlocking a lifetime of work. And we did it with all professionals, we did it with corporate execs, we did it with business owners. And as time went on, it became clear that the business owner was the one that frankly had more complexity around them than just, I mean, the corporate exec did, but everything was sort of put together for them. And certainly the professional did around it. But the business owner had a lot of complexity around that. And the other thing that was really good about business owners is that they knew how to delegate. They realized early on if they were going to be successful, they couldn't do it all themselves. And so they were comfortable with hiring professionals, even though admittedly they necessarily didn't do it well. And that's some of the things that we try to educate them on. So it became a storyline of, how can I continue to help enough other people get what they want. And what everybody's looking for, I hear it over and over and over again, is where's my financial safety net? Most business owners have all of their eggs in that business. Very few of them have taken enough out. So when we work with them, that keeps them motivated and moving, but it also creates a lot of stress and anxiety around that. So that's how we move. So for 40 plus years, I was working inside of Wall Street firms. It was E.F. Hutton, and then I went to Payne Weber, which was subsequently bought by UBS, and I spent the bulk of my career at the Swiss bank, UBS. And on my 65th birthday, 2.5 years ago, because my son had joined me and I had a relatively young team, and we knew that we wanted to be able to bring more to the table than just investment and wealth management. We really wanted to bring the business consulting side to be able to really help these business owners figure out how they can exit successfully, transition successfully. And that was something that, in the way we wanted to do it, was a little bit more challenging. Inside of these Wall Street firms and banking firms. So on my 65th birthday, where most people go to the Social Security office, as I told you, we launched Interchange Capital Partners, and that was 2.5 years ago. And with the idea that we already had proven that family businesses are looking for help to reduce the complexity that surrounds it, and at the same time build out successful strategies. So that's pretty much where we are. And I'm a young 67, and my father worked until he died when he was 85, and I think he taught his last class when 3 months before he passed away. It's sort of in my DNA. One of the things that I've learned over the years of helping people through the transition is how once they have moved on to their next chapter, they always say, well, what am I going to do next? And, I hear it all the time with friends, they're bored. There's only so much golf they can play, unless you've got this really strong set of hobbies and other kinds of things. I know you do, Ron, for it, but, a lot of others don't. And so what they really have is their business. I've got some other things as well that keeps me occupied, but it still goes back to that basic core. if I can help enough other people get what they want. And this is so important. The mistakes that are made here have generational consequences. It's not just you, it's your family, it's your employees, it's your community. So it's really just fits well. And because I get to do just the things that I love to do, and I can delegate all these things that aggravate me or irritate me. Why retire? Why not keep going and doing the good work and keep improving other people's lives? Around this very challenging transaction.
Let's jump back to the succession and all that stuff. We both know that at some point everybody's leaving. You're gonna leave your company, I'm gonna leave mine, whether it's whether it's in a wheelchair into a mental facility or in a
Pine
casket, we're
Box.
all gonna leave, right?
Yeah, I mean that's the interesting thing. There are certain immutable laws. And what like gravity, right? If you jump off a building, you're not going to go up. You're going to go down. And the same thing with this succession transition. It's not if you're going to exit; it's when. And the question is, how do you do that so that you can be successful at it? And I get the fact that there's a lot of people, as we just talked about, and I'm sort of one of them, where, well, what else am I going to do? But nonetheless, you still have to begin to plan and groom the next generation, for it. Again, helping the others with that. And so that's one of the classic mistakes that, well, I have time. Well, you don't have time because you just don't know. We all believe and hope and pray. It's all about hope and faith that we're going to be here tomorrow and we're going to be here healthy. It doesn't always happen that way. And the transition and succession, in order to be successful, takes time. The more time that you have, the interesting thing about all of this is when you think about people who started the business, the things that you need to do for a successful transition and succession are just good business practices. So even if you're even if you're like, well, I don't know when, and I don't really want to talk about it, the things that you have to do to get to a successful transaction is going to be good for your business. And ultimately, that's what you want. When we talk to business owners, there's three things that they're interested in. Obviously, they're interested in their business, they're interested in their families, and they're interested in their employees and their customers. Some go a little farther, and it really is because they're a major player in their community. So there's a lot of stakeholders that are involved in this, and there's only so much time in the day. So I get that, and that's where having a good partner like us at Interchange can assist you. We like to tell people that what we really are doing is we're giving you an extra hour, 2, 3, 4, you name it, because you can delegate to us, and then we can act as the financial chief of staff, if you will, around this very large, most important financial transaction of your life. So I get the fact that people don't focus on it. We're trying to get them to recognize that focusing on it does the things that they would normally do. They get up every morning, and what they want to do is they want to be better for themselves, their family, their employees, their customers, and that ultimately leads to a richer, more valuable life.
It's interesting. There's a lot of people that start going through the process of prepping for an exit. It's kind of like this analogy's come up on the show a few times. It's kind of like going out. You're thinking about trading your car in, so you go out and you have a few things done, so you get the highest trade-in value, and then so you get a few things done to it. Then you have it detailed, and like now you're driving it to have it traded in. And you're like, this isn't so bad. Why am I trading it in? Same way with what happens a lot of businesses is if you go through the process of decentralizing everything away from you, to like you don't have to be the guy that knows everything and does everything. Put in the systems and operate the standard operating procedures so that other people can be trained without you having to train them. You go through all the different steps, and now you've got a business that you can actually take a month vacation from, and it still is growing, probably sometimes better than it would when you were there. Yeah, it makes a big difference. People don't really get that these are just great business practices, and it'll free up a lot of your time. I
Yeah,
was
and I think that's part of it. I know we're going to talk a little bit about tax mitigation. That's always a big thing. But one of the issues that happens when you sell any asset, and a business is obviously your biggest asset. You've got most of your equity involved in that. There's going to be a tax bill on it. But if you can create what we call a self-managing company, okay, which is that term was coined by Dan Sullivan, out of Strategic Coach. If you can create a self-managing company that you can create some tax favored income for the rest of your life out of that, then there's no taxes at this generation, and
and
then
it
you can pass it down. So the idea of what you're bringing up is that idea that if you put these practices into place, you can create a self-managing company that does a number of things, not the least of which is, hey, I get to do what I love to do, whatever that may be. And part of that, and you reach a certain point in life where it says, yeah, I'd like to take a month off. I'd like to take 6 months off. And I've been at this for 40 years. Maybe I want to take a year off and do some other kinds of things, and know that you've got systems and people in place. So that's one. That's unusual, but I want to put that out there for the one who says, I never want to leave. Okay, don't leave. But let me ask you this. Do you love everything that you do every day? And usually the answer is, are you kidding me? I can't stand this, but I don't know what else to do. And then we start working with them around, okay, what is your unique ability? What is it that you love to do? What are you passionate about? We always find out that in a lot of cases, the number one place, certainly first gen, or even it's not first, even second gen, the leader of the company loves to be the cheerleader, loves to be out there in the sales process somehow of telling, working with a select client, working with new ones. So that frees that space up for them to be able to do it. And all of a sudden, yeah, okay, now I'm not leaving, but I'm enjoying my life more. And to your point, they're making even more income because they've learned how to empower their team and their management and even their family members who are part of this.
it's interesting is a while back I had a guy reach out to me, and I don't do mentoring, but this guy reached out and said, "Hey, I would like to. I've heard about aqua hire where you're hiring people and stuff." He goes, "I want to aqua retire." I said, What are you talking about?" He
Right.
goes, "My 401k isn't big enough for me to retire at the moment. I want to acquire a company that's big enough to where I can put an operator in. I'm just an advisor. I come in once a month or once a quarter, do some advisement and coaching or whatever because I've done this for years, and they run it." And that's a great idea for somebody who's owning a business. What if you just become the advisor, right? Like you, like half retire.
Right.
There's a name out there's a people out there that refer to kind of half retiring, where they bring in an operator, a CEO, or sometimes a family member to step up and run it. They go into an advisement role, and they get to do the parts they love. They hold on to like those pieces. So I love that concept, right? I love the concept of you don't have to leave, you don't have to sell to enjoy your next phase.
What I said to my son and my other partner, I said to both of them, I said, I'll tell you what, I will look to give up my CEO role in 3 years when I'm 70. Okay, so I've got another 2.5 years. Now, will I actually end up giving that up? I don't know, but I do know that I am giving more and more responsibilities and allowing the organization to do more and more. And that's really good because I can watch and I can offer that advice and counsel and coaching. I mean, again, we tend to deal with very successful businesses. We're not dealing with startups here, so the mistakes that are made are not monumental that are going to bankrupt the company. There's mistakes like your accounts receivables are out of whack. You've got the wrong people on the bus. You don't necessarily have the right strategy, your execution, your cash, those kinds of things. And you can work with that. And a term we use is, how can, as the owner, if you will, become the inconsequential owner? Not the, doesn't mean you're out. It's just you're not, the whole business doesn't revolve around you. And that's a critical ingredient. And yet you can stay involved, you can stay engaged, you can still do the things that you love to do. And what that's going to do is equal what we call the successful. So we've talked a little bit about, let's define that. What are we talking about when we say a successful exit or succession or transition? First, it's maximum value. You've put your whole life into this thing. You don't want to, it's like someone walks into your house and want to pay you $100,000 less. No way. You want maximum value. We talked a little bit about, there is always a potential tax bill, depending on how you do it. So how do you mitigate the taxes? Too many times, again, without the planning, they're shocked. Oh my God, I didn't recognize. I didn't get as much as I thought. When we've talked to business owners around and say, well, what happened? Well, one of the major, number one comment that they said, I wish I had done a better job of tax planning. And the planning requires time. And requires the right people. So mitigate taxes. And then this is a part that really gets people to stay away from this, and that's cash flow. They control their business. They understand the cash flow of the business. They know they can always go get another project that can go in. But all of a sudden now they take this money, and they're really, many of them are not comfortable in all the different investment options that are available out of control, and how do they cash flow their life. So that's the third part. And then finally, staying in control. All of that requires some time and energy, and it requires pulling together these three different areas that creates the complexity.
What are those three areas?
There is the family, there is the business, and there's the ownership. And each one of those have different goals. So families' goals are generally nurturing. You want to nurture. That's what family's all about. I'm going to nurture, I'm going to protect you of it. The business goals are profitability. I got to be profitable. Ownership goals is future enterprise value. So you've got three competing goals here. So you have to know. So when this hit me, it was like a light bulb. It was like that aha moment. I get it now. I understand why family businesses are so complicated, because you're working within three systems, and each system has a different set of priorities. And so which hat am I wearing? Is the family business, is the business here to support the family or the business? It's like an existential question, that always needs to be addressed. So I'll use my family as an example. All right. I've got 3 children, a wife, and 3 children. I have one son. My oldest son is in the business with me. So there's me and my son, and then we've got 3 others in the family, and then we've got spouses. We got 2 spouses. We've got 2 grandchildren. So that's all sits on the family side. When it comes to the business, Brian and I are sitting in the business. So we have to think about the business differently than we think about the family. They're competing interests. Now let's talk about owner. And inside the business, we've got 8 different employees that do different things. And then we have a ownership structure. And the ownership structure has three players. We have me, Brian, and one other person who's a minority. And so now each one of those, every decision, has to be looked at through 3 different lenses. So you have to know Where are you? So that's what creates all the complexity. Each system has its own pieces, and then working within each system to be able to do that. So that creates the complexity around that.
If I were to ask, and in the last 2.5 years, I've probably interviewed 300 business owners that are looking to sell. I was involved in a pretty good sized roll up, so that was 200 of them right there. But I would imagine if we had brought that question up, do you keep a business income statement? Do you keep your home in the same thing? Do you have a personal income statement? I can think of maybe 3 people that in that entire time that would have told me yes, because it wasn't. Now, if it was in the financial services industry, I bet there would be half of them at least, right? The number would go way up for financial
I'm not. I'm
planners.
not. I'm not sure of that. You
Okay.
know, I'm not. Sometimes like the shoemaker, doesn't have to. The fact of the matter is, and again, there are certain business principles. So
Yep.
and part of what drove me to this is I started to realize that what we were doing before I made the switch to primarily business owners, it was really taking a page from how successful business owners operated. They ran things by numbers. They cash flowed everything. Yet what I found is when they moved from that business and looked to handle, they didn't do that across the board. You never make a business decision or an investment unless you are convinced and know that you're going to get a return on that and you're going to be able to cash flow that. So the idea of that identify and quantify first phase is just that. What's the balance? What's that income statement look like? And it doesn't have to be elaborate. It's really another way of saying, what's it going to cost you and your spouse and your family to live your life in the lifestyle that you've grown accustomed to? I mean, it doesn't have to be the kind of an income statement that you have to have if you're going to sell because the buyer's going to want audited financials and stuff like that. On the personal side, you get some latitude. But to your point, most people don't know that.
Let's dive a little deeper into this. What is succession planning process? And I don't mean into the each gear you have to turn, but from a high level, what are the different things that you guys see? If somebody wanted to get started today, where would you have them start in that
Yeah,
succession
we
planning
talked
process?
about there's 3 phases to it. So
Yeah.
the first phase is identify and quantify. So you really need to understand the financials on both sides, the business, because it's ultimately about the utility of the money. The second phase is maximize and protect. And that's where you're, again, building inside the business. You're looking at the business from a buyer's standpoint, which is very different than you looking at it. So there are, 2 big areas. There's what we call value drivers, the things that are driving your business, and value detractors. One of the classic value detractor is customer concentration. You don't your customer base is concentrated one or two. You lose one or two of those, you're in trouble. Now the issue is you are the main contact with those 1 and 2. So that's a value detractor. What's a value deliverable? What that's a value driver. You got a strong management team. You've already started to move into that what we call the inconsequential, the ownership. So that's a value driver. So there's a whole series of that. So you want to maximize and then you want to protect because this takes time. There's a risk element to this. Again, we want to make sure that if something happens to you during the process, that the family's okay, the business is okay, the ownership is okay. So that's the second part, maximize and protect. And that there's series and series of due diligence checklists. Another simple one is employee contracts. You have intellectual property. What happens if one of your employees takes your intellectual property and then goes competes against you, or takes your customers and goes competes against you? Do you have these kinds of documents and legal protections? Again, to protect. And when it comes to maximizing, do you have the right people on the bus? That can be a value driver or it can be a value detractor. And that's probably the first place that you have to look is, and I remember when I learned that question from Jim Collins, the book Good to Great. I said, "Oh my God, I don't have the right people on the bus, and I have to manage them. If you get the right people on the bus, you get out of the management business with them, especially if you tie that in. So that second phase of maximize and protect, there's a whole series of things depending upon where the business is. And then the last phase, which is the phase that people tend to go to all the time, is the transaction or the transition, because that's where the fun is. Oh, I'm going to get my check, and how we can do it. But if you go down those if you go there first, which is where a lot of people, and sometimes it's not their deal, they get the proverbial knock on the door. I'd like to be able to buy your business. And so, but in many cases, people move to that without doing phase one and phase two. They're setting themselves up for failure around that. So those are the three in very large areas, and some of the things in terms of that maximize and protect. When you get to transition and transaction, there's generally two ways that you're going with this. You're either going to sell it internally, which is what most of them go to. Okay, most businesses get sold internally, either to a management company or they get sold to I'm not either to their management or to family. That's the internal. And then there is external and the strategic, which is the one that a lot of people want because they get their cash, but they don't, in many cases, they don't realize what they've got. What happened? They got the cash, but then they got consulting agreements. They're not happy. All of a sudden, they're not doing what they love to do. So those are the transition and transaction. And inside that, how do you go about doing it? So those are the three phases that you want to go through. But again, go in order. Always identify and quantify, always maximize and protect at every stage. So when the transition and transactions there, you're ready.
I've looked at a lot of operating agreement, a lot of due diligence stuff, and one of the things I'd say consistently is missing are some of the stuff you brought up in that protects phase. Key man policies. If you're not a sole entrepreneur, if you're not the CEO and own the 100%, and you have other partners, that key man policy basically is just an insurance policy that, what happens if something happens to you, and letting the family adjust while that buy sell agreements inside of that key man policy. So a good key man policy, insurance policy, this is an insurance policy you can go to insurance broker and buy. A lot of good ones, if you have business partners, will actually allow or actually facilitate your family getting paid, so that the business transaction was what they're looking for, transfers, I guess is the word I'm looking for, to the partner, and the owner is bought out at a certain valuation or whatever.
Right. I mean, the issue with that, just because you bring that up, I can tell you that one of the things that we uncover frequently is they're antiquated. The buy sell agreements were done early. The insurances were done early. When you now take it the real value, when you start taking a look at what the family's income sheet needs to look like if something happens, it's antiquated. And that's an area where you definitely need to be able to do that work, because there are many buy sells that are there, but they're not funded, or if they're funded at a very low valuation. And again, this comes back to, I guess the biggest thing is time. There's only so much time. We all have 24 hours. And if you're busy with your business and you're busy with the family and you're busy with the community, where are you going to get the time to do this very important work? And that's where our process around helping people with the exit, but it's beyond that now. It's also helping them with execution, which is working through a setup of meeting huddles and different cadences around meetings, so that you can create time by having meeting cadences, certain types of meetings, and having the right people on the bus. And at the same time, and we haven't talked much about this, it's the model that you're using for advice and counsel, which is in most cases very fragmented and ineffective.
How often should somebody update their key man policies, their insurance policies, buy-sell agreements, all that stuff?
Yeah, I generally stuff like that. I generally say you should have a review 3 to 5 years. Every 3 to 5 years, just make sure you're reviewing it. Is it still appropriate? It's not something. And again, this goes to the time allocation. You do it once, you put it away. You say, okay, I'll look at it again in 3 to 5 years, unless there's a significant material change. Like all of a sudden you have a banner year. All you have this new product, this new innovation, you're killing it, and then and you totally forgot, or you have a divorce, or you have a death. If there's a material change in circumstances, then it's right away. But assuming there's no material change in circumstances, every 3 to 5 years is sufficient.
I would almost say, because 3 to 5 years in the startup world, it could be insane. Like, if you're under 10 years old, 5 years old, and you're still in that mad growth phase, that could be an insane valuation difference. So, what about looking at, and this is just an idea, I haven't even thought about this until you brought it up. What about looking at it as growth of the company? So, if your company grows more than, say, 50%, that
Right,
could
that's
be
the material
20%.
change.
Yeah,
That
yeah, it's
that that's what I call material change. You get
yeah,
a 50% growth, you should be looking at all of this stuff. And frankly, that's where you should be looking at your players again.
yeah.
Your internal and your external. Who are the people that are on your bus? Are they still, a lot of times there's that old story. The people that got you here are not going to be able to be the ones who are going to take you to that next level. And that's
I'm
both internally and externally.
You brought up Dan Sullivan. I'm a huge fan of some of his work too. His book, Who Not How, is just
Oh,
incredible, right? It's a game changer. So if you're trying to figure out if you got the right people on the bus, I think that would be your first step. There's an exercise inside of there. I forgot what it's called now, but it's a one sheet exercise so you can figure out who I can identify your who.
right.
There's a
Yeah,
ongoing joke that my daughter, I didn't know, so I'm hearing impaired, so I always wear headphones. And wear like even when I'm listening to audiobooks or something, I'm listening to that book on audiobook on my headphones, and I didn't realize that sometimes I actually use bone conduction and my headset at the same time. So I'd use two different sides of headset, like when I'm listening to music that has like, especially like classical music where the variations, because one picks up sounds very well that I can't hear, and the other one vibrates my skull where I can hear those tones. Well, anyway, my daughter had one on and I had the other, and they were in sync, and I didn't know she was listening to Who Not How, and she thought I was listening to a Dr. Seuss book. She's like, "Well, Daddy, why are we listening to this?" Is 3 years ago or so. She's six
right.
now. She was 3 or 4, and she's like, "Why are we listening to the Owl book?" And I said, "What do you mean?" She's like, Who?" The guy keeps saying who, But that's
Yeah,
a brilliant way to they have an exercise. I still use the sheet, but it's a one sheet type of thing where you identify the elements of who you're looking for.
right.
And
I mean, you identify what the project is. You say, okay, this is what the project is. This is what the ideal outcome looks like.
right,
Now, what are the qualities of first of all, do I have a who
right.
in my organization? And if not, what are the qualities that I'm looking for? And then you start to do that. I mean, the who, not how is also the beginning of that process of starting to become inconsequential owner, because you start to realize it really goes back to one of his other principles, which is, what are you passionate about? Your unique ability. If you stay in your unique ability zone, then you're going to have a wonderful life and keep building bigger futures. And you'll have to consistently find who's, because our imagination, how many times have your listeners had, oh, I got this phenomenal idea. It's way too big for me. I don't have the time. Well, wait a second. If you've got this really phenomenal idea, find a who.
Yeah.
We all reach this ceiling of where it stops us, and the who, not how, is a way to be able to move. And that works very, very well with businesses. When you find yourself in a lot of drama in your businesses, identify the drama. What do I need to do? What's that ideal outcome look like? And then, do I have that right person in the bus? Because if you have the right person in the bus, now it's a little more complicated than that. There's some other pieces to it, but who, not how, is a great way to begin to expand, build your bigger future, and at the same time start that important delegation process.
Yeah, it's brilliant that it says anytime you're thinking about how do I figure this out or how do I do this, you're asking the wrong question. It's like
Correct.
who's already awesome or who's already great at doing
Right.
this,
Right.
right?
Which goes back to people.
Yeah,
You know, people who do I have the right people on the bus?
yeah.
So, in every business, that's your first question. And if your listeners who want to get to succession and transition, if they have to have, we talked about identifying, quantify, that's very important. Identifying is also people. Do I have the right people? I can't tell you how many times we talk to businesses and all they're doing is complaining about this one, this one, this one, and this one. They're not doing this. They're not doing that. They're not doing this. They're not doing that. I have to do all of this. Well, you got the wrong people, folks.
We brought up tax planning and tax mitigation for quite a few times. I know we don't have a whole lot of time left. Can we go over what are the basic premises when you're looking to do succession, looking to sell, looking for ways to fund the after business life, right? What happens when I'm no longer here 40 hours a week, 60 hours a week? What are some of the tax planning things that people need to look into and research that you guys help with?
Yeah, I mean, basically, we're not tax advisors, so the number one is to make sure that the accounting firm that you use has that capability. Too often, what we find is we have business owners who have an accountant who's very good at preparing tax returns. They're not good at tax planning, and that's critical. So it goes back to what I said, making sure you got the right people. You also have to make sure you've got the right professionals around you. A very dear friend of mine who had a accounting firm was in the process of selling the business. It was recommended at the time while I was going through that to hire another accounting. This has been a accounting firm that was with the family for decades. And he turned around, he made the decision, and there was millions of dollars that was left on the table because it was inappropriate planning. The simple things around that has to do with qualified plans, retirement plans, and non-qualified plans, where you can, that aren't tied to ERISA. The other thing has to do with, are you a C corp or an S corp? And how that operates. There's a tremendous tax planning opportunity for C corps versus S corps and vice versa that you want to be able to look at. What you have to understand about tax planning is time. You got to be thinking about this not a year, not 3 years, 5 years, 3 to 5 years at a minimum, and even longer around this stuff so that you can build up some of these types of plans. But there are many of the QSBC, Qualified Small Business Credit, which a lot of people don't understand, is a major tool that we're using right now with the appropriate circumstances. But again, because we don't give tax advice, I'm not comfortable presenting it
Okay.
out to everybody. But it clearly is a major area because it's going to take a portion. I'll use me as an example. In my previous life, my buyout of my equity within all these Wall Street firms would have come to me as ordinary income. Ordinary income, is upwards of 40%. Now that I own the business, I can now get it out as capital gains. That's huge. That's a major change, in terms of going from 40% to 25%. And again, it's going to take time. I can't do it right away. There's all kinds of things. So tax mitigation is an important area. It's something that we work with, and it's the way we work. The one thing I keep hearing when I make presentations and talk to people is this whole idea of the model that they're currently using for advice and counsel. They're siloed, separate conversations. So, in other words, like you are in the middle of everything with your business, you are in the middle of all your advisors. Major mistake. And the reason why is this requires tax, legal, insurance, banking, investment. Be honest with yourself. All progress starts with telling the truth. What do you know? Are you strong enough in tax, legal, insurance, banking, and investment? And if you're not, that means how are you synthesizing and evaluating and analyzing all the information that you're getting from all the advisors? And are you getting it proactively or reactively? And most people are getting reactively. I know I have a problem as a business owner. This is the professional that I know can solve the problem, and I go to them. That's the mistake. Versus having someone like Interchange Capital who acts as the hub of the wheel, that chief of staff, where we understand everything and we know enough about all this, and then we coordinate all that information, and you have this board of advisors around you that are vetting all of this, and you get this interdisciplinary, multidisciplinary approach, which creates much more efficient and effective outcomes. Again, the problem is time, and the problem is, do they have the talent? But there's another reason that people think, oh, I don't want to do that. That's going to cost me a lot more money. It's just the opposite. It's going to cost you less because you're not going to go down rabbit holes that you shouldn't be going down, or you're not going to buy inappropriate types of products and services because you've got a vetted solution. So, this idea of getting a collaborative, comprehensive model with someone leading that to move you out of the middle is another critical component to a successful growth and exit strategy for a business.
Having your own advisory board, taking all the because most of these guys are using advisors of some sort. Somebody's doing their taxes, somebody's doing their accounting. They have a lawyer. They might have a marketing company. To have a at least quarterly, if not monthly advisory board meeting where you put everybody on a Zoom call and say, "Here's what we're working on." I think that would be brilliant. I think that it's worth the shot trying for any size business.
Yeah, I would say it quarterly. I don't think you need, again, depending upon material changes, you might need them daily, weekly, or monthly. But in most cases, if you have a quarterly or semi-annual,
Hmm.
with that, certainly in your business, you should have daily meetings, you should have weekly meetings, you should have monthly, quarterly. All of them are different agendas. The daily meeting is the one that people say, oh, well, we don't have time for the daily meeting. The daily meeting is only 15 minutes. Okay, it's not where you go through. There's a very clear agenda for what you want to do in your daily meeting, because that keeps the execution going. To grow the business, you need people, you need an appropriate strategy, you need the execution, you need the cash. And so the idea of having the data. But the idea of meetings is another major topic area that most people, when you say, oh, don't talk to me about meetings, don't recognize that the way they're doing their meetings are totally inappropriate. It's really just a forum for one person to just speak. And there's ways to create effective meeting and meeting cadence, which will help build growth as well.
It's interesting is I used to be really against. I was in the corporate world. I was really against them because we just seemed to have meeting overload. Right, especially I came from the defense contracting world. I went from military, which there's lots of meetings, and
Right.
then which was structured and they were very structured and very productive. And then I went into the corporate world, like working for defense contractors, and lots and lots of meetings and not so productive. A lot of times you're just having a meeting for the meeting's sake. And then when I went into the private sector, I was so fed up with it that if you asked me to come to a meeting, I would have my assistant come with me and we document everybody is in the room. And whoever hosted the meeting, we'd send them a mock invoice of what that meeting cost. Because we kind of had an estimate of what these engineers would make and what we
Right.
made and everything else. And we sent them that meeting cost, some of these meetings were 30, 40, $50,000 meetings as
Sure.
far as the salaries in the room and there's some, what you call it, estimation of opportunity cost too, because not only are you pulling those engineers into a meeting, so you pay them for their hours being there, but there's the opportunity cost of what could they be working on.
Sure.
where would their projects be if they didn't go to 6 hours of meetings a week? So we used to send these, mocked up invoices that would say, hey, look, this is what it cost. It's okay. Was it
But you
worth
should
it?
know.
Right.
Right.
You should know that this is what
No.
this meeting cost the company. It cut them down. People would get a lot more succinct in what they wanted to meet with. A lot of times they would not invite such broad groups to the meeting,
Right.
and they would, pick the right people and stuff. I get it. And, but now I lean the opposite way. It's like I meet with individuals one on one to do things, but I don't, even for the businesses I own, we don't do a daily gathering,
Yeah,
you know.
you'll find that the daily, and again, I have to credit my son who read a book, Scaling Up, and which
Hmm.
we are working on certifications, coaching around that with Vern
Yep.
Harnish. Credit Vern and what his company has done around this daily huddle. When we
Yep.
introduced the daily huddle to our organization 3 years ago, it changed everything. It was amazing, because the idea behind that daily huddle was very specific. What are you working on today? That's the first thing. And where are you stuck? So you don't, and it has to be very specific. And then
Yeah.
what specific KPI or key performance indicator price. So it's very quick and it has to be very specific. It's done in 15 minutes, and it's over. And then from there, if it requires more, so that daily huddle is something that I know a lot of people don't want meetings. It was a true game changer for us, and it allowed us to uncover the issues. Without it, issues showed up over and over and over again. And this was so it's a very proactive. It's not the kind of thing, they recommend everyone stand. You're not sitting around. You're not to be comfortable. You're there. Tell us what you're working on today. Tell us where you're stuck. What's the priority that you're gonna work on, and that's it, and you're done. I get that. Meetings have, like we said, there's pluses and minuses, but they're important because part of the key is the communication, with us. So I would turn to your listeners, those that have businesses, and say, well, at a minimum, get your daily huddle with your leadership team. Okay. And then move from the daily into a weekly. All right. And then you have that regularly, and then you move to a monthly. Your monthly is a little longer, and then quarterly. And it's just amazing what you can get done when you have structured agenda kinds of meetings. And again, that's all part of that other, we talk about exit and succession, but as my son reminds me, we're in business to grow. We want to build this. And, even those that want to sell and exit their businesses, they still want to grow. They want to become more efficient and effective. And, so there's a growth component to the kind of work that we do as well.
So how do people reach out to you? How do people get a hold of you
I
and,
mean,
and,
the
and talk
best
with
way is to send us an email at team at interchange, C as in capital, P as in partner, interchangecp.com. That's the best way. Send us an email. It goes there. And then with that, we do offer a second opinion service. Where we're happy to take a look and see, where you are in terms of your readiness for exit. Where are you in terms of that identify and quantify? Just get some sense of that. So that's on our dime. So we're certainly willing to sit down, and our commitment to you is, if we can add value, we'll certainly tell you how we can add value. We work on a project basis, so you'll know very clearly what it costs and what's involved. And we'll give you 3 different options in terms of, what you want: good, better, best, whatever choice you want in terms of what you're looking for. But if you're doing everything okay, we're going to tell you that too. We're looking for those business owners, those family businesses, or closely held businesses, not just all family businesses, closely held businesses who are saying, look, I know where I want to go. We're not getting there. We're stuck somewhere, somehow. I may be stuck on the family side. I might be stuck on my business side. I might be stuck on my ownership within those 3 systems, and we have that expertise to be able to help take that complexity and reduce that through proven tools and techniques that have helped thousands of businesses and entrepreneurs through our varied backgrounds and experiences. So best way, team at Interchange CP, C as in capital, P as in partners.com. That's the best way to reach us.
Awesome. That's great. Well, I want to thank you for being on the show. We're going to wrap it up here and hang out for a few seconds after it's over.
My pleasure. Thank you.
All right. Hey, it's your host, Ronald Skelton. I want to thank you personally for watching the show today and invite you to call our new hotline, 918-641-4150. That's 918-641-4150. Call us and tell us about our show, ask questions, suggested guests, or even tell me about a business you have for sale, and we'll reach back out to you. Again, that number is 918-641-4150. Call our hotline, leave us some information. Thank you. I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between $5 million and $30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT-enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace, how to exit. That link will be in the show notes. Visit them now. The Investors and Entrepreneurs Professional Mastermind. The Investors and Entrepreneurs Professional Mastermind combines the traditional peer-to-peer mastermind introduced first in Napoleon Hill's famous book, Think and Grow Rich, with accountability partnering, where your peers help you ensure that you set goals, take actions, and get results. If you want to scale, blow past roadblocks, and achieve success faster than you might think is possible, I suggest you take a visit over to TIEPM.com. That's TIEPM.com and check out the Investors and Entrepreneurs Professional Mastermind.